welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. Back in April of this year, we hosted our first in what's becoming a series of debates. Once again, we have John Hathaway, Managing Partner and Senior Portfolio Manager at Sprott Asset Management, serving as today's moderator. Our two guests are Don Luskin, investment strategist and founder of Trend Macro, which focuses on macroeconomic analysis and forecasting. We also have David Rosenberg, founder and president at Rosenberg Research, which focuses on macro and market insights. I'd like to now turn it over to John Hathaway to kick off today's conversation. John?
Okay, Ed, thank you very much, and welcome to David and Don. Looking forward to your comments over the next 45 minutes or so. There's a lot to cover. I would say the big three topics in my mind are inflation, recession, and the Fed. And I think there are other things we could talk about. Certainly geopolitics could fit into it. But I would say let's just start out on the subject of inflation. David and Don, I think you both feel that inflation is a thing of the past. I would just ask both of you for your arguments on why inflation has been vanquished and whether or not the Fed acted prematurely and may be triggering a new round of inflation with a return to easier monetary policies.
I have the old-fashioned belief that Milton Friedman won the Nobel Prize for in 1976, that inflation is ever and always a monetary phenomenon. And since there are all kinds of different ways that the money supply can be increased or decreased by various government entities responsible for it, primarily the Fed, but from time to time, including the most recent time, the U.S. Congress, then you can never really say that inflation has confidently gone away any more than you could say dandruff has gone away. You can make it go away for a while by treating it, but you always have to be vigilant. It might come back. And so I take the spirit of your question to be, has the multi-generation bump in inflation that we experienced in 2021 and 2022 that now seems to have returned back to the Fed's target, has that reliably gone away? Well, I think the answer is yes. I don't believe they caused inflation. I don't believe they're responsible for having cured inflation, at least for a while. I think that what caused the inflation was real simple. Over about a 12-month period, the money supply went up by $6 trillion because there were three back-to-back-to-back stimulus bills that were voted by two Congresses and two presidents. It was a bipartisan spending fiasco that injected just cash money right into M2, right into people's savings accounts, money market funds, and checking accounts. The idea was to stimulate the economy out of the disaster of the COVID lockdown that should have never happened in the first place. But it did, and we had to buy our way out of it, and that caused inflation because on a year-over-year basis, that caused the money supply to rise by 27%. That beats the previous record by about a factor of 2. And that record we saw back in the 70s. So that's where we got the inflation. Now, what's given us the disinflation is they stopped passing these stimulus bills. Oh, yeah, I mean, under President Biden, there have been some spending bills, but they haven't been $6 trillion. They've been $1 trillion apiece, two of them, and one of them much less than that. They staged their payouts over a decade. It doesn't make a big difference to them, too. So, of course, inflation is going to roll over. And I think inflation would have rolled over just about the same, even if the Fed had kept interest rates at zero. Now, there's no reason to do that, so I'm glad they didn't. But I don't think the Fed caused this inflation. I don't think they cured it. Now, another amazing thing is they also didn't cause a recession. Now, David and I may disagree on whether, we're going to be able to look back, say, 3 or 6 months from now and still say that, but it seems like so far they haven't. That's pretty miraculous. And so what that's telling us is that when you can take rates from 0 to 5 3/8 in just call it a 24-month period and not cause a recession, when they said they wanted to, right? That's really telling you something. That tells you that regardless of what the near future may bring in terms of recession risk looking forward, that means that at least over the last 3 or 4 years while the Fed has tightened, we've had an amazingly robust, almost kind of a post-war boom economy coming out of what I like to think of as World War III, which was the war that all humanity waged together against the virus and won. The Fed was unable to cause a recession. So the Fed must be coming to the conclusion that the natural rate, the neutral rate of interest is much higher now than it was in those awful years of secular stagnation after the great financial crisis. After the great financial crisis, the 10-year yield was on average 2.5%. So about a year ago, we saw the 10-year yield a little bit above 5%. We haven't seen that since before Lehman. Now, 5% isn't all that high a 10-year yield. If you think that's really abnormal or really high, well, that just means you're young. There's nothing special about that rate, except that it didn't cause a recession. And remember, the Fed panicked in 2019 after they had raised the funds rate to 2 3/8. That used to be seen as a high interest rate. Well, we've been at much higher interest rates for a long time, and it hasn't caused a recession. So the Fed is not as tight as it thought. That means when it starts cutting rates, it's not going to have to cut them as deeply as the market now expects, and I think even as the Fed now expects. And if the Fed does cut too quickly, then there is a risk that there'll be an inflationary resurgence. Now, nobody knows where the neutral rate is. I don't. Jay Powell doesn't. Dave Rosenberg doesn't. But I don't know. I'll bet nobody would disagree that it's something south of 4 7/8, where the funds rate is. Now, I think the markets think it's about 2 7/8, 3%. I don't know. I think probably in the 4s. I don't think the Fed's going to venture below that. If it does, then inflation's going to come back. Simple as that. I'm going to say one more thing. After we stopped passing all those stimulus bills, the money supply actually outright contracted on a year-over-year basis for the first time in official history, which begins in 1959. Now, the historians tell us it contracted during the Great Depression, and I believe them, but the official data starts in 1959. At worst, about a year and a half, 2 years ago, we had a contraction in M2 of 4%. Having it be a contraction at all on a year-over-year basis is completely unprecedented. And yet, all that's happened with inflation is we've gotten approximately back to the Fed's target. We didn't have deflation. We had a minus sign on money supply growth, but we never got a minus sign in prices. So if you can have the only time in history when you have a contracting money supply on a year-over-year basis and not have deflation show up after you wait for it a year and a half, say, not have that show up in CPI on a year-over-year basis with a minus sign in front of it, well, that tells you that going forward, we can probably tolerate in this economy less money supply growth than we could have, say, 5 years ago, 10 years ago, 20 years ago, without causing inflation. So, we've brushed the dandruff off our shoulders. It could easily come back if the Fed doesn't recognize we're in a new world.
Okay, David, Don seems to be fairly comfortable with the idea that haven't experienced a recession and are not going to. I'd like to hear your view on that.
So I just want to remind everybody that when Donald Trump got elected in 2016, everybody thought we were going to be having an inflationary cycle. And despite the fact that he did raise tariffs, and despite the fact that he built this immigration wall against labor, and then we closed 2019 before COVID with GDP growth running between 2 and 3%, and we had the unemployment rate at 3.5%. Where was headline and core inflation back then? It was roughly 2%. And then, of course, we had COVID, which was an initial deflationary shock, and then it turned into a massive inflationary shock because of all the demand stimulus from the government that bumped against deterioration we had in the global supply chain structure. And next thing you know, we went from almost 0% inflation to the summer of 2022 to 9%. And that, of course, got corrected because, as Don accurately said, we have not seen recurring fiscal stimulus. There's still stimulus that's in the system from the lags from a couple of years ago, but that impetus to demand is gone, and the supply chains, by and large, have been restored. We'll see, what happens in the Middle East, and we'll see what happens with the stock worker strike, which I think will be just short-term in nature. But the supply side has experienced a significant thaw on the product side. And at the same time, if you remember, everybody was talking about the great retirement theme and that women were never going to come back into the workforce because of childcare costs and because of lingering fears over pandemics. And here you've got the prime working age adult participation rate at a 2-decade high. So you've had a tremendous thaw in the product market on the supply side, tremendous thaw on the labor market on the supply side, bumping against the fact that the stimulus from fiscal policy has subsided dramatically. My approach towards inflation is always about supply and demand. And that's why you want to talk to an economist in any event, because how you get the price of anything, including the aggregate price level and its direction, is by identifying the shape and the movements in aggregate supply and aggregate demand. So firstly, when I talk about the fact that we've had this expansion in the labor force, and actually the pool of available labor in the United States now is running about 10% year over year. We'll get a fresh number on Friday. But we've got productivity growth running very close to a 4% annual rate. And this is without the benefits of AI kicking in yet. This is all productivity that really was stemming out of companies having to digitize and automate during COVID. A lot of the old economy sectors, even retail, that never had productivity growth, realize that we either become Amazon or we fail. So productivity growth of almost 4%, John, productivity is an inherent inflation killer. And this is before the benefits, whatever they will be, from the AI wave that lies ahead in the future. So you've got this tremendous boost to the supply side of the economy happening when demand growth, while still positive, is cooling off. People like to point to GDP growth of 3%, but with all due respect, a third of that growth was inventories. Really, underlying demand in the United States is running a bit below 2% at a time when the supply side of the economy is expanding at a 4% annual rate. So you see what's happening here, John, is that we are building up excess capacity, excess supply in the U.S. labor market, as the trend and the unemployment rate is telling you, not the level, but the trend. And of course, the industry capacitization rate is trending lower. We're building up more excess supply in the economy, and this is still early days. So there's not a snowball's chance in hell. You can look at the supply-demand curves right now and lead yourself to an inflationary conclusion. You know, as far as the call on the recession, I understand the recession hasn't come yet. But look, I come from a framework where the United States is an intensely credit-driven and interest rate-driven economy. And interest rate cycle and the market cycle, the economic cycle, are these centrifugal forces. They're like sine waves over time that move with each other, but they don't overlap necessarily with each other. But there are long lags between interest rates and the real economy. And I'll just take you back, because we'd be having the same conversation, I believe, probably in the summer of 2007. And Don would be saying, where's this recession already? And John, I'm sure you'd be saying the same thing. Remember, the Fed started raising rates in June of 2004. And the recession that nobody saw started in December 2007. It takes time for interest rates to work in both directions, and it's not unusual at all to see those lags between 24 and 30 months. And that's where we are right now. And they work in both directions. Historically, after the Fed cuts rates, if you go into recession, the rate cuts will generate an economic recovery, but that's usually roughly 18 months after the first rate cut. So I would just suggest, let's not be so impatient. Let's not be tempestuous. And please, let's not ignore the business cycle. The business cycle has not been repealed. It's just that the lags are often very long. And then what happens invariably is that people throw in the towel because the recession hasn't arrived yet. But it'd be very unusual after this interest rate shock that we've endured and continue to endure. What the Fed did at the last meeting was a speck of dust relative to the damage it has done from 2022 to 2023. So I understand that people don't believe there's going to be a recession because it hasn't happened yet. But I'm not fussed at all. Remember, the Fed started raising rates in 1988, and the recession didn't start till July 1990. Similar situation. Where's the recession? Give it time, and just respect the lags between what the Fed does in time A and what the economy does in time Z. That's my point.
So I would just point out that 80% of money managers believe that we will have either no recession or a soft landing. You know, it seems to me, and I really don't want to inject too many of my thoughts into this, if you read earnings reports and guidance from companies like FedEx, Dollar General are two that come to mind, the consumer is struggling and business is slowing. What would be your thought as to when our patience will be rewarded for those of us who are expecting to see a downturn?
The markets right now have been trained by the Fed to focus on coincident and lagging indicators. The leading indicators are already there. Most of them, not all. But I think that the last man standing is always non-farm payrolls. So once non-farm payrolls decline, and I think when they decline in the first month, people will be saying, oh, it's just 1 month, it's not a pattern, so on and so forth, because nobody really wants to call for a recession. But I think that we'd have to wait for payroll employment to start declining. Now, what's interesting is that the household survey has already shown employment to be declining. And the number of jobs in the household survey are down 66,000 over the past year and down more than 1 million for full-time workers. What's interesting is that companies are hoarding labor. They're shifting people from full-time to part-time, and they're cutting hours. So they're rationalizing on labor by not firing people because of the miserable experience of doing that in 2020 and 2021, and then you can't find them again. But the one thing that I'm noticing is that the hiring rate has already, and we got the numbers from the JOLTS today, the hiring rate is like a hot knife through butter. It's down to where it was in the second quarter of 2020. And that is actually the best leading indicator. The hiring rate leads the firing rate. But I think that what has people confident there's no recession is that the labor market, in terms of the level of employment, hasn't started to contract yet. So I think that as far as the markets pricing that in, and some markets have priced that in. Look where the treasury market is. The equity market's in a different universe altogether. Up until what China did on their liquidity measures. These weren't like real measures to bolster the economy, but as bolster investor sentiment. Commodity prices were in a pretty significant downturn. Oil, base metals up until this week. The equity market, on the other hand, I think that when you talked about the Bank of America survey, you're talking about equity investors, and equity investors always have a positive hat on. I rarely met it unless you run a short fund. Every equity portfolio manager I've ever gotten to know in my 40 years in the business, they're always optimistic. So, that doesn't mean a whole lot to me. For the markets to actually say, we're seeing the whites of the eyes of the economy, they're going to have to see the lagging indicator of employment, and I'm talking about payrolls, start to show minus signs in front of it.
Could you just, for clarification, the hiring rate in the JOLTS report, has that been declining sharply? Is that, you said a knife through hot butter?
Yes, the hiring rate has gone below 2%. If you see the chart of just the hiring rate alone, you'd be wondering, where is this rosy-posy, Goldilocks, soft landing view coming from? The hiring rate is in a fundamental bear market. Boy, I'd love to show that chart to a technical analyst. And it's down to its slowest level since when the economy was in the pandemic lockdown recession in the spring of 2020. What's holding the glue together is the firing rate, which we see in the jobless claims data. The firing rate has remained inordinately low because the business sector is like the little boy with the finger in the dike. So they've not been laying off people. Like I said before, the household survey is much richer in terms of the information it provides. It's a lower sample size, higher error term, to be sure. The payroll report that everybody trades off of gives you industry information, but doesn't give you any more information about the quality of jobs that are being created. The jobs that are being created are basically in part-time, self-employed, and there is an absolute boom, John. There is a boom in the number of people taking on more than one job, multiple job holders. If you looked at the job of multiple job holders in the United States, people taking on more than one job. And by the way, this isn't, this is the gig economy. The gig economy has been around for a while. This has just happened in the past several months, the past year. This is basically people are so stretched that they're taking on more than one job. This is actually a classic contracyclical indicator. But you see, the payroll survey doesn't tell you that. It's in the household survey. So the bottom line here is that companies are hoarding labor. At the same time, they are dramatically reducing their hiring rate. And at some point, I don't know what month this is going to happen, okay? But at some point, we're getting close. At some point, the hiring rate is going to overtake the firing rate. And then we're going to get non-farm payrolls printing negative. You're going to get all the shills and mountebanks telling you to ignore that. It's just temporary. But that's when the ball's going to be rolling towards the recession that everybody thinks isn't going to happen. And that's when the Fed is going to be becoming very aggressive on its rate cuts.
Okay, great. Thank you. Don, I'm sure you've been saving up a lot of commentary on this. Let's hear your response.
Well, first, I actually agree that there's sufficient statistic that will tell us when this long-awaited train of recession finally reaches the station we've been waiting at so patiently is indeed when you start seeing payrolls roll over. And the reason I say that, David, all your arguments are very good, but the reason I say it is that isn't it funny how in conversations like this, we all throw around the word recession as though we all know what each other means by it, right? So, you know, some people think it means 2 quarters of negative GDP. Well, if that's your standard, we had that in Q1 and Q2 of 2022. And, you know, the NBER didn't call that a recession. Why? Because payrolls rose every month during those 6 months. So the NBER does not publish a formal definition of recession. They're kind of like the Fed. They just say, we'll know it when we see it. We look at the totality of the data. But if you look back at the history of when they've declared the end of a business cycle expansion and the onset of a recession, it corresponds essentially to the month, to the first time you see a negative payroll print. So, you know, if we're going to, you know, we can agree on whatever definition of recession we wish for this conversation. It's up to us. But if we want to use the official definition, then the business cycle is the labor cycle. So, you know, fair enough. You know, let's wait until we see that. While you were talking about the household survey, I was just looking up the numbers. I don't know if you've made, David, the appropriate adjustments for the annual changes in population controls. If you do that, it's not quite the long-term downright decline that you're talking about. We're not at all-time highs. You know, I'm not saying it's the most robust picture, but what I do every month, on the first Friday when the jobs report comes out, is, you know, I look at those 2 surveys, the payroll survey and the household survey, and I say, okay, you know, these are the headlines. This is what everybody's looking at. Let's fact check them. Well, there are all kinds of other good labor market indicators that have different degrees of precision and different degrees of objectiveness. You mentioned claims. That's a good one. Challenger layoffs, the employment component in ISM, manufacturing and non-manufacturing, ADP, you know, there are a couple others. So I've built just a, you know, very simple Excel-based regression model, which goes back and just sort of munges together all those labor market statistics that aren't the ones that come from the BLS every first Friday. And they show something that's more optimistic than the household survey and less optimistic than the payroll survey. And I believe in multimodal research. I think if you have more than one source, you should try to look at them all and put them together in a kind of synergistic way. And I think you're more likely to come up with the right answer that way. And if you do that, then you wouldn't have been surprised at all by that warning of what the annual benchmarking process is going to do to payrolls. Well, you know what that is, David. You know, that they're going to take 818,000 jobs off when the jobs report comes out for January of next year. Well, what do you know? My model would have come up with that literally exactly the same number. That's how much payrolls have been off. So if you ask me, we're looking at a labor market that is, as, you know, I hate to say it, as Jay Powell says, it's a maximum employment market. Now, just because you're at maximum employment, you know, I suppose that means you're on a high, narrow pedestal and you're riding for a fall. I mean, you can't fall out of the basement window. We're not in the basement. Yeah, we're in the penthouse in the labor market. I get that. But just because you're in the penthouse doesn't mean you're going to throw yourself out the window. So, of course, the higher rate is slowing. Of course, we're at maximum employment. And so that to me is not inherently a warning of anything, unless I thought there was some huge pool of people that was desperately seeking employment who couldn't get it. And that's not the case. The labor force participation rate is back to the pre-COVID levels. So, and I believe you made that point yourself, David. You know, I don't disagree with your facts particularly. I just don't see how those are recession indicators. You didn't quite say they were. Your recession argument is based on long and variable lags, and I respect that. You know, that's a perfectly reasonable way to look at it. That would be to quote Milton Friedman. I do want to say one thing about that, though, and that is, you know, you and I, David, both earn our living by being something like economic historians. Both of us are very facile with the data. We both try to get it to tell us the truth. I think we've probably both been known to torture it until it confesses. But at least it's objective data. One of the things when you play that game is that you have to assume, is it the four most expensive words on Wall Street or this time it's different? There is a book called This Time It's Different. That's a wonderful book. I treasure that book. Its title is sarcastic because it's saying, no, this time it's not different. It's never different. And when you go into a credit cycle, well, it's never different. There's going to be a consequence. I accept that. Except I think this time it's different. And the reason why I think this time it's different is because the experience we all lived through together in 2020, when all the authorities of the world decided within a matter of weeks that we had to basically completely shut down the global economy, that induced a global depression. So in the US, where I happen to be familiar with the numbers, within a month, we got to a 15% unemployment rate. We went from 3.5% to 15%, like in 1 or 2 months. We lost more than 10% of real GDP. That's 2.5 times what we lost in the 6 quarters of the Great Recession, where we only lost something like 3.8%. And that was a Great Recession. So when you lose 10% in just 2 months, there's no other word for that but depression. So to see those unemployment rates, to see that loss in output, you truly have to go back to the early 30s. The big difference between what we lived through in 2020 and what our grandparents endured in the Great Depression is they had to go through a whole decade of it. And they didn't get out of it until World War II presented the greatest public works effort in the history of the world. We got out of this in 3 months. We had a standard V-shaped recovery like you would normally have from the most shallow recession, from a depression. There has never been, I will put to you, in human history, an economic fluctuation that negative, that deep, that took such a short period of time. So when you come out of that, all of our trusty economic historical knowledge that we've used to guide ourselves through all our long careers and that lead to maxims like, don't ever say this time it's different. Oh my God, is it different this time? We got to throw out things like the index of leading indicators and the yield curve and all these things that have been calibrated over many loving decades to work in a world that isn't the world we're in. This is a unique moment in economic history for economists, for strategists, for investors, where you need to wait and see the whites of their eyes.
If I can replay that, Don, you basically think that we're in a completely different world where we need to toss out these traditional precursors or warnings of recession, yield curve inversion, that sort of thing. To put it from David's point of view, there's still time for these lags to work, and we'll just have to wait and see. I guess my only observation would be that the markets are pretty much on your side, Don, in terms of not expecting a recession, a lot of trust in the Fed. And if David turns out to be right, there's going to be a lot of upset in the markets. We could talk about this forever, and we have a limited amount of time. Don, I listened to a webcast that you hosted. It was an expert, I think he was at the Manhattan Institute, talk about the fiscal projections under both a Harris and a Trump administration. And I was frankly horrified with the projection. I think the takeaway for me was that under either administration, we would in 10 years be talking about $4 trillion deficits as a matter of routine. And so I'm really bringing this up so we can shift to get both of your views on the issue, which for me has been constantly concern, and that is what appear to be the intractable fiscal issues that the U.S. faces. I would just like to sort of get a sense of whether you are concerned by the lack of willingness to address fiscal issues.
I guess I would say that I'm concerned, but I guess we could all say we were concerned back in 2016. Donald Trump added trillions of dollars. I mean, we're on the wrong side of the Laffer curve. The corporate tax cuts, the income tax cuts never paid for themselves. The tariffs never paid for themselves. And the debt ran up under Joe Biden as much as it did under Donald Trump, even adjusted for what happened with COVID. So, here you have Don on and you, John, saying, well, the stock market is just ratifying Don's view. The stock market's a wonderful place. Well, it's been a wonderful place for years with the fiscal deficit ramping up. The dollar's weak, but is the dollar collapse? Tell me, after we've added on all this debt, what apple cart has been upset by it? So we can sit here and talk about deficits and debts, and I guess I don't know what you would have done 8 years ago talking about the same thing. I got a couple of points on this. The first is that when you talk about the bond market, fiscal policy is not the only thing that goes into your equation when you're forecasting bond yields. I mean, you would have to therefore answer, how is it that since last October, the national debt has gone up $1.4 trillion and the 10-year Treasury note yield's gone down 125 basis points? So, John, how is that even possible if you're so concerned about deficits and debts that are going to cause the Treasury market to implode, and it's not as if the Fed's doing QE? So what's going on? What's going on is that there's other things that matter for bond yields, like inflation expectations, and Fed policy. And as I said before, the interaction between aggregate demand and aggregate supply. It remains to be seen. You could have fiscal policy that gives a boost to both the supply side and the demand side. I think Donald Trump's policies will do both, because cutting top marginal rates in the corporate sector should unleash more capital formation, which is disinflationary as a static standalone event. And he's pro-deregulation, which leads to lower business costs. That's disinflationary. And then we have the situation with tariffs if he goes ahead with them, but that's not a sustained source of inflation. That is a price level shift. Kamala Harris, her policies, I think, are more traditionally Keynesian in nature, and her policies demand relative to the supply side. I think, and this is where I'm different than the consensus, I think her policies are going to be more inflationary, even accounting for the tariffs, which was, I said, he's not going to raise tariffs 100% every single year. It's going to be a huge shock, that's for sure, but it's not a primary sustained source of inflation. So it's not just deficits and debts, it's also what's the nature of fiscal policy and how is it influencing inflation and inflation expectations. So if you're going to say to me, John, I got a framework here that both candidates' fiscal policies are going to be very harmful for inflation expectations, it's going to place the Fed in a box, I'll say, okay, that's negative for my interest rate call. But it's so much more complicated than that. And I think that, look, it's like, Don and I agreed, when employment starts to decline, and for the Fed, and for the markets, there's only one number that matters, which is non-farm payrolls. At the same time, you're in a fiscal crisis when you have a failed auction, or if you have some sort of destabilizing plunge in the U.S. dollar. Like, you and I go to that conference in Vail. How many years in a row have we heard from people talking about a cataclysmic plunge in the U.S. dollar, and that all these BRIC countries are ganging up against the U.S. because of fiscal policy and, of course, freezing the Russian assets? Has that even happened yet? But the one thing I will say is when interest costs, and I only say this because we got the Canada experience of a near-failed auction and a crisis back in the early 90s. When interest expense starts to drain more than 30% of the revenue base, you're in deep doo-doo. And we're still more than 10 percentage points away from that, but we're heading in the wrong direction. That's the point where the risk of a real serious fiscal crisis. It's not about the debt. It's not about the deficits. It's about basically what a corporate CFO would say, what's your interest coverage ratio? And that's when the rubber is going to meet the road. So yes, I'm concerned, but in terms of the impact on interest rates, it's really complicated, more complicated than to just say, well, deficits and debts and the bond market's going to blow up, because you'd have to answer as to why it hasn't happened already. Bond yields didn't go up in 2022 and 2023 because of fiscal policy, because of debts. It went up because we had inflation and the Fed went nuts in terms of raising the cost to carry. That was your story for the bond market. It wasn't about deficits and debts. insofar as the fiscal policy stimulated aggregate demand at exactly the wrong time and created the inflation, well, that's a different story altogether. But that's the story you'd have to turn the deficit's debts into a story of rising interest rates has to somehow come down to what it does to inflation.
Okay, good. I guess my only observation here is I think the strength in the bond market could be discounting a recession. Certainly, that would be one explanation for.
Hold on, John. But John, you just said that the markets were in favor of Don's forecast, the Goldilocks economy. So then you're saying that the bond market's saying one thing and the stock market's saying another thing. Is that what you're saying right now?
Yeah, I think that's right.
Well, then I pose the question back to you. In your history, which market gets it right more, the bond market or the stock market?
Bond market.
Case closed.
Bingo. Let me interject on that point and just say that compared to where we were a year ago when, for a brief shining moment, we had a 5.01 10-year yield. Now it's, 3.72. I understand that higher 10-year yields, among other things, are correlated with higher growth expectations. So maybe we have lower growth expectations at this point at 372 than we did at 501. Fine. But 372 is not a recessionary number. There were very few moments in the 15 years after the great financial crisis when we got as high as 372. There are people on Wall Street whose whole careers have thought that 372 was an oh my God high rate. You want to know what a recession number is? 31 basis points on the 10-year, March 7th, 2020. 61 basis points on the 30-year, March 7th, 2020. This is, if this is a recession forecast in the bond market, it's a mild one.
Well, I think what we all want to know in Sprott land is, or what we would observe is that the strength in the gold price may be discounting a lot of things. David, you mentioned de-dollarization, and I think you dismissed it as an issue.
Only for the impact on interest rates.
It may be concerns about possibly a premature rate cut in a strong economy, which is Don's view, is that we're not going to have a recession, and maybe there was reaction to that. Obviously, there's geopolitics. I don't know how we factor that into any of this discussion, except to say, well, it's there and it's probably just an imponderable. But for me, the strength in the gold price may be an advance warning of maybe it's not a sovereign debt crisis tomorrow. Maybe a recession will prevent that from happening because money will flow into bonds as a safe haven. But I think a lot of markets look ahead on a much longer term basis. And we've seen the gold price go up 70% over the last 5 years, very quietly, without a lot of Western participation. So I would be curious to hear from either of you if you have any thoughts on that particular subject, which is near and dear to my heart.
Yeah, I'll just kick it off and just say that the performance of gold, especially in the last, say year and a half, has been especially amazing because it's done it in the face of a background economic scenario that is normally adverse to gold, which is we have gone from many years of negative real rates to pretty strong positive real rates. And we got there in a hurry. Pretty amazing that didn't kill gold. It normally does. And for gold to have just, gradually made this assault on new all-time highs, just kind of sneak it up there a little bit every day while that was going on, whoa, gold's even stronger than it looks if it can do it versus that. So that's another case of throughout the playbook, yes, this time it's different. And John, I would like to give you an idea that you might want to use in the future. I know that it's a tradition among gold investors to think of gold as an insurance policy against catastrophe. And I don't dispute that. I have a lot of physical gold, but gold is also a thing you need in increasing prosperity. So you get a nation like China, boy, they're going to need a lot more gold in their central bank than they ever thought. The Chinese central bank is so ridiculously undergolded compared to all its peers. That alone is going to keep gold trudging to new highs. And, that's going to be all the more so when the world economy grows and when China grows, because as the world economy grows, you need more gold to be the collateral for the credit of that growing world economy. It's just like if you bulk up, you work out, you get bigger muscles, you're going to need a bigger jacket.
No, I think that's right. Certainly, it's a play on emerging markets. It's a play on rising prosperity in underdeveloped nations. All of that. It's just interesting that yes, it has broken all the rules. Real interest rates are positive. That was supposed to be bad. People come to gold for many different reasons. What's, I think, very interesting is that it's done it without any participation from people in the United States or Europe who can't wait to sell the gold they have. There's some mystery to it. Lots of people think they have a reason for it. I think your explanation is a fair weather, positive way of looking at it. It isn't necessarily catastrophic the way, traditionally you hear from people in the gold camp. And I don't disagree with that. I think it's good to have a fair weather explanation. And that may well be it. Could be just that. Anyway, I would like to just ask either of you if you have any closing comments. It's been a great discussion. Thank you both for your participation. I would look forward to another one, especially maybe when the train comes into the station on non-farm payrolls. For me, I don't trust a lot of this data, but it does move markets, and that's what you all have to work with. Anyway, any concluding comments from either of you?
Oh, I just want to thank you, John, and thank you, Ed, and thank you, David Rosenberg, who I've tracked your career the whole time. I wasn't always a economic strategist guy. I had to learn this business. And one of the ways I learned it is I learned by imitating you. I admire you very much, and it's really nice to finally get to meet you.
Well, the feeling's mutual. I'll just start off. I'll finish off, John. I didn't get a chance to talk about gold, along with treasuries, and probably a more accurate call than treasuries over the last several years. But it's been my highest conviction call for a whole bunch of reasons, and I don't have a price target because it's hard to have a price target on something that doesn't deliver cash flow stream. So I don't know where gold's going. I know that it's got several tailwinds, and when the tailwinds subside or turn to headwinds, I'll change my forecast, whether that's 3,000, 4,000, or 5,000. But I will just warn you guys and the viewers that the day that gold hits the peak will be the day that I change my name from Rosenberg to Goldberg.
Beautiful.
You heard it here first.
That's so beautiful.
That's a great note to end on. Thanks, everybody.
Thank you, John, and thank you for moderating this. Our hope is to do one of these about every 6 months. It seems like 6 months is just enough time for things to change, for better or worse. So please keep your invites open. We'd love to see you guys back on. I would also say for our listeners who'd like to learn more about our guests today, both Don and David, I encourage you to look them up on LinkedIn. They both have tremendous followings there. But I also encourage you to check out their respective websites. Don's website at Trend Macro is trendmacro.com. And I encourage you to take a look at what Don's working on over there. And same for David Rosenberg at Rosenberg Research. Surprisingly, his email is also rosenbergresearch.com. So I encourage you to look them up on LinkedIn. I encourage you to check them out on their website and see what they're up to and what they're thinking about. And John, as always, thank you for moderating. You do a tremendous job with that. So hopefully we all learned something today. And once again, thank you for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.